Many Americans spend decades contributing to their 401k plans, believing the money fully belongs to them and that retirement will automatically become financially easier once they stop working. People contribute year after year, collect employer matching contributions, watch the balance grow, and assume they will simply withdraw money slowly during retirement while paying only small amounts of tax along the way. Unfortunately, retirement tax rules are far more complicated than most workers realize. What many people discover too late is that traditional retirement accounts like 401ks, traditional IRAs, 403bs, and TSP accounts are not completely tax-free savings accounts. They are tax-deferred accounts, which means taxes are delayed, not eliminated. Every dollar eventually withdrawn from these accounts is generally taxed as ordinary income. That retirement income stacks on top of Social Security benefits, pension payments, interest income, dividends, capital gains, rental income, and any part-time earnings during retirement. One of the biggest misunderstandings surrounding retirement planning is the belief that retirement automatically lowers taxes. In reality, many retirees end up creating large taxable income streams later in life without realizing it during their working years. This is why retirement tax planning before 2026 is becoming increasingly important. The year 2026 is not simply another calendar year for retirement savers. It is a critical planning window for several retirement-related tax decisions. Some retirement rules continue beyond 2026, and some deductions currently remain available through 2028. However, the 2026 401k contribution window, catch-up contribution window, and many Roth conversion planning opportunities close permanently on December 31, 2026. Once a tax year closes, missed contribution opportunities and missed tax planning windows generally cannot be recreated later. For anyone with a 401k, traditional IRA, TSP, 403b, SEP IRA, or another pre-tax retirement account, understanding these rules before the end of 2026 could potentially save thousands of dollars in future taxes, Medicare surcharges, and retirement income complications. The first major issue involves required minimum distributions, commonly called RMDs. Under current Secure 2.0 rules, most individuals with traditional retirement accounts must begin taking required minimum distributions at age 73. These withdrawals are not optional. The IRS calculates the required withdrawal amount using account balances and life expectancy formulas. Retirees cannot simply leave traditional retirement money untouched forever. If someone fails to withdraw the required amount or withdraws less than required, the IRS can impose a penalty of up to 25% of the amount that should have been taken. Many retirees are shocked when they first learn about this rule because they assumed retirement savings could remain invested indefinitely. The larger problem is not only the forced withdrawal itself. The real issue is how that additional income affects the retiree's overall tax situation. RMD income stacks directly on top of other retirement income sources. Social Security benefits, pensions, investment earnings, interest income, dividends, capital gains, annuity payments, and retirement account withdrawals all combine together to determine taxable income. As retirement balances grow over time, future RMDs can become surprisingly large. A retirement account that continues growing for many years may eventually force retirees to withdraw tens of thousands of dollars annually, whether they actually need the money or not. Those withdrawals can increase federal income taxes, increase the taxable portion of Social Security benefits, and potentially trigger higher Medicare costs. This leads to another major retirement issue known as IRMAA, which stands for Income-Related Monthly Adjustment Amount. IRMAA rules affect Medicare Part B and Part D premiums. Medicare uses modified adjusted gross income reported on tax returns to determine whether retirees must pay higher premiums. Once retirement income exceeds certain thresholds, Medicare premiums begin increasing even though retirees receive the same Medicare coverage as everyone else. Many retirees do not realize that retirement account withdrawals, Roth conversions, capital gains, interest income, and other taxable income can all contribute toward crossing these Medicare thresholds. For some retirees, even moderate increases in retirement income can lead to years of higher Medicare premiums. This creates a situation where retirees may effectively get hit twice, once through higher taxes and again through increased Medicare costs. This is one reason retirement tax planning matters so much before required minimum distributions begin. The earlier people understand how retirement income stacking works, the more opportunities they may have to reduce future tax pressure. One strategy many financial professionals discuss is the Roth conversion. A Roth conversion involves moving money from a traditional retirement account into a Roth IRA. Taxes are paid on the converted amount during the year of conversion, but qualified Roth withdrawals may later become federally tax-free. One of the biggest advantages of Roth IRAs is that original account owners are not subject to lifetime required minimum distributions. That means retirees may gain greater flexibility over how and when retirement money is withdrawn. However, Roth conversions are not automatically the right decision for every person or every situation. Large Roth conversions completed in a single year can push retirees into higher tax brackets, increase the taxable portion of Social Security benefits, and trigger Medicare IRMAA surcharges. This is why retirement tax planning requires careful calculations instead of emotional decisions. The important question is usually not whether someone should convert everything into a Roth account immediately. The more important question is how much can safely be converted during the right tax years without creating unnecessary tax problems. Current tax rules also create temporary planning opportunities for retirees age 65 and older. Under current IRS guidance for tax years 2025 through 2028, eligible seniors may qualify for additional deduction opportunities depending on income levels and filing status. These deductions may create additional room for carefully planned partial Roth conversions at lower effective tax rates. For some retirees, years between retirement and age 73 may become valuable planning windows. During those years, taxable income may temporarily remain lower before required minimum distributions and full Social Security benefits begin. Carefully planned partial Roth conversions during lower income years may reduce future traditional retirement balances and potentially reduce future RMD pressure. The key idea many people miss is that the most effective retirement tax strategies are often gradual, not extreme. Smaller partial Roth conversions completed over multiple years may sometimes create better long-term outcomes than large one-time conversions. Another important retirement planning topic for 2026 involves catch-up contributions. Under Secure 2.0 rules, workers ages 60 through 63 may qualify for higher catch-up contribution limits compared to other workers. In 2026, the standard 401k contribution limit is expected to be $24,500. Workers age 50 and older can generally contribute an additional $8,000 catch-up contribution. However, workers ages 60, 61, 62, and 63 may qualify for an enhanced catch-up contribution amount of $11,250 instead. This increases the potential total employee contribution limit to $35,750 for eligible workers during 2026. For many individuals in higher tax brackets, these additional contributions may create meaningful tax savings, while also strengthening retirement savings during important earning years. There is also an important Roth catch-up contribution rule beginning in 2026 for certain higher income employees. Workers earning more than $150,000 from the same employer during the prior year may be required to make catch-up contributions on a Roth basis instead of a traditional pre-tax basis. Because of this rule, workers should confirm with their HR department or retirement plan administrator whether their employer plan properly supports Roth catch-up contributions before the end of the year. Waiting until payroll closes or tax forms are already issued may create unnecessary complications. Retirement planning is not a single decision made once at retirement age. Retirement happens in phases, and every stage creates different tax consequences and planning opportunities. Ages 60, 62, 65, 67, 70, and 73 all affect retirement income planning differently. Social Security timing changes retirement taxes. Medicare eligibility changes healthcare costs. Required minimum distributions change taxable income. Pension elections affect long-term survivor income. Every stage of retirement planning interacts with tax rules differently. People who carefully manage retirement income over multiple years may potentially reduce future tax pressure and preserve more retirement assets over time. Small planning decisions made before retirement often become more important later because tax flexibility tends to decrease once required distributions begin. Another issue many families overlook is how retirement accounts affect beneficiaries and inheritance planning. Under current Secure Act rules, many non-spouse beneficiaries inheriting traditional retirement accounts must fully distribute inherited accounts within 10 years. Withdrawals from inherited traditional retirement accounts are generally taxable as ordinary income to the beneficiary. This can create large tax bills if children inherit retirement accounts during their highest earning years. For example, a working adult already earning a strong salary may suddenly inherit additional taxable retirement income on top of existing earnings. Larger withdrawals from inherited accounts could potentially push beneficiaries into higher tax brackets. Qualified Roth accounts are treated differently for many beneficiaries. Although the 10-year withdrawal rule may still apply, qualified Roth withdrawals may remain federally tax-free. That means beneficiaries may keep more inherited money instead of losing large portions to taxes. This is why retirement tax planning is not only about the retiree. It can also affect spouses, children, and future generations inheriting retirement assets later. Important retirement planning questions include, will future RMDs create unnecessary taxable income? Will retirement withdrawals increase Medicare premiums? Will Social Security benefits become more taxable? Will surviving spouses face higher tax brackets later? Will inherited retirement accounts create tax burdens for children? Will future retirement income become harder to control? These are serious questions many people never fully evaluate until retirement is already approaching. Another important reality is that retirement tax planning becomes more difficult with age. Once retirees reach their mid-70s and required minimum distributions begin, flexibility often becomes much smaller. Earlier planning years may provide opportunities that disappear later. Workers and retirees who still have lower income years available may potentially benefit from reviewing retirement tax strategies sooner rather than later. Waiting too long can reduce available options. There are several practical steps people can take before the end of 2026. First, review current retirement account balances, including 401ks, IRAs, TSP accounts, and other pre-tax retirement savings. Second, review IRS publication 590-B to better understand required minimum distributions and retirement withdrawal rules. Third, workers ages 60 through 63 should contact HR or plan administrators to confirm eligibility for Enhanced Secure 2.0 catch-up contributions and Roth catch-up contribution requirements. Fourth, estimate total taxable retirement income, including Social Security, pensions, dividends, interest, investment gains, retirement withdrawals, and potential Roth conversions. Understanding total projected income is extremely important for evaluating Medicare IRMAA exposure. Fifth, speak with a fee-only fiduciary financial advisor or CPA who specializes in retirement tax planning. Specific questions about partial Roth conversions, future RMD projections, Medicare IRMAA thresholds, Social Security taxation, and retirement income coordination can help create a more informed long-term plan. Retirement tax planning is not about fear or panic. It is about understanding how the rules actually work before important deadlines pass. Every tax year creates opportunities that disappear permanently once the calendar closes. The earlier people understand retirement tax rules, the more flexibility they may still have to make informed financial decisions.